My name is Peter Jeroge. I'm with Pete and Pete Investors. We're based here in New Jersey, USA, and like Robert, we do a lot of education to our Kenyan community, people from diaspora. We teach equities markets, stocks, options, futures, and our goal is really just to move the needle in terms of understanding what capital markets are, what they can do for us, how we can build generational wealth. And apart from that, I'm enrolled in Boston University CFP designation program. So in about 10 months, we'll have good news about financial advising to everybody here in the US and also in Kenya. My goal here is to give you some information on how to invest in the NSE as a diaspora or someone that lives abroad. And what Joanne did was just give you tools on what they do. I'm going to take a step back and just share some information on what you as an investor should have in mind and prepare yourself in investing. So I already introduced myself. I'm just going to go through very quickly. I have quite a few slides and I want us to make sure that you capture all this content as clearly as possible. I always say that this is for education and information purposes only. If you're going to be investing, you need to be working with a financial planner or advisor. And there's no guarantees in the capital markets. If somebody guarantees you a lot of money, you should run very quickly because there's really no guarantees. All right, so having said that, I'm going to go quickly into these slides and see whether I can provide, from my experience, what I've found helpful. So these are the three things that are acceptable if you're going to be investing. I said I'm going to take a step back. Before you invest, we need to go back and figure out what should I do? How should I prepare for investing at NSE or even New York Stock Exchange or German DAX? It doesn't matter. Whichever securities exchange you're going to be investing in, you need to be prepared. So these are the three acceptable investment goals. The first thing you need to do is provide for your family. The second thing you need to do is save for a future need. And the third thing you should do, if you are able to, is leave an inheritance. That's the order of events when you go to work or you hustle or whatever it is. You first of all provide for your family. Then you can save for a future need. All right. Now, the question here is whether you have established a money map. And if this is the first time you're hearing of a money map, then you're in the right place. Because if you don't have a money map, then you have not identified your short-term, medium-term, and long-term goals. You will need to figure out where you are in this journey. Just like any journey you're going to take, you need to prepare. And a money map is going to help you a lot. You start by savings and then you move on. So it's important to have a money map for you and for your family. Now, the one thing that is clearly important is cash flow. And a cash flow is just a written plan. You know where your money is coming from, where your money is going, and you know the differences between needs, wants, and desires. It seems recently that we have lost the importance of this order. Some people will tell you that I want this because I need it. But you need to identify what are needs, what are wants, and what are desires. And I usually put it very quickly as this. You are hungry, you need food. So perhaps a sandwich or a baked potato would do to satisfy this need. But you want a burger with fries and a shake. And you desire that that burger be served by an attractive person in a silver service restaurant. That's the definition of needs, wants, desires. Do not confuse these ones. Your needs, your wants, your desires. So for most people, cash flow is identifying where money is coming from, whether it's through a job, whether it's a paycheck, whether it's a business, and where it's going. So at the end of the month or at the end of every 2 weeks when you get a paycheck, you're either net positive, you're net negative, or you're just breaking even. If you don't know where you are, the money map is going to help you. You need a budget. Before you invest, you need to have some understanding of where your cash flow is. Now, one thing that Robert and I does a lot, when we speak about investments is a system we call PYF. So pay yourself first. Most people, pay bills, and then at the end of paying everybody else, then they can say, oh, now I'm left with $50 I can invest. You need to reverse that order where you pay yourself first. Identify how much money you're going to pay yourself first, and then do automatic transfers of that payment into savings or investing. So having said that, now we have laid the groundwork for how to invest at NSE or New York Stock Exchange. Let's now turn our attention to the stock market. What is the stock market? Forward-looking mechanism. A lot of people don't understand that the stock market is always looking forward. It discounts a lot of noise. It discounts a lot of information that you pay attention to and looks forward. Now you realize during pandemic, the market dropped at some point and then started to rally out. And it kept going up and up. And some people are really confused. Why is it the stock market is going up, yet everything seems doom? Just like NSE right now. People are complaining about taxes. And by the way, I feel for most Kenyans on this tax issue. But that feeling of everything is going to doom, the country is collapsing, everything, you'll notice that the market will start turning around because it's looking forward. 5 years from now, it won't be the same. 10 years from now, things will have changed. So you need to understand when you invest in the stock market, you are looking forward. It can be right or wrong about a company. Right now, Safaricom is trading at 15 shillings. Some people will say, oh, that's really cheap, or it's too expensive. The market will always adjust to new information. It can wiggle around, it can move, and it's usually based on supply and demand. So a lot of people would want to buy a stock, it will always go up. Or if a large investor comes in and dumps that stock, it's going to move down. Now, the one thing that I want you to pay attention to, because we are going to look at this later on, is what is a business? If you're investing in the stock market, you are investing in companies that do business. And those companies are usually listed in a stock exchange so that the public can participate in that business. Anytime you buy shares in a company, you are a shareholder. You are part owner of that company. Now that business is going to be making money. It's a money-making machine. Now, if it makes a lot of money, it can be able to generate quite some dividends and share with you. Or it can do so well so that that price keeps going up. So if you look at the stock market and you want to invest, the one thing you want to ask yourself is, what business is that company in? And is it a money-making machine or not? If it's not making any money, it's not going to survive, it's going to collapse. All right, so when you want to invest in the stock market, the one place that we look at is charts, because charts are going to give you an idea of where that particular stock is trading at the moment. And it's going to give you a comparison of where it's been in the past and what is happening right now in that particular price. So as an investor, you're going to picture or form an opinion about that stock moving forward. It's just giving you a story. It illustrates I've been to $3 or 3 shillings. Now I'm at 15. At one point I was at 45. Now I'm back at 30. So the chart is just going to answer that question for you. And you will realize if you look at it, just using your eyes, is it going up? Is it going down? Or is it just wiggling around? Is it zigzag? Is it stagnant? And sometimes that's all you want to know. If it's going up, you can join the trend. If it's going down, then you have to figure out, should I wait or should I sell my shares? So I mentioned laws of supply and demand. This is key if you're going to be buying anything in the stock market. Demand and supply. If demand exceeds supply, price will turn higher. And if supply exceeds demand, price will turn lower. Think of it when you go to Masai market or Kenyatta market and everybody is selling eggs. What happens to the price? It go down because a lot of people, there's a lot of eggs. So all the sellers are trying to sell their good and they will discount each other. Or if you go to the same market and find out that there's only a few handful pieces of meat and everybody wants it, the price will go up. That's just natural law of supply and demand. It does the same thing in the stock market. So if we have a lot of demand, the market will rally. If there's a lot of sellers, it will drop. And if sellers and buyers are in equilibrium, or both of them cannot outbid each other, then it's going to base. So those are the three things that you're looking at chart: rally, a drop, or a base. So there are two basic types of analysis, and this is where Steve and Joanne had asked me to consider. If you are going to invest in the stock market, what type of analysis are you going to use? And there are just two of them: fundamental analysis and technical analysis. So fundamental analysis, you see a lot of managers looking at numbers. And I know Robert is one of those analyses that looks at numbers. He is focused on fundamentals of the company. How strong is the data? Are they making money? Is there revenue? What is the balance sheet? What's happening to the next quarter? Yet some traders don't care about this. They say you should not even worry about data. Just look at the chart. If it's dropping, sell the stock. If it's going up, buy the stock, right? So you have to figure out what is important for you as an investor. Is it data, or is it a chart, or a combination of both? Now, if you're going to be a technical analysis investor or trader, then you're going to look at a chart and start working on some of these jargon here. It's a lot of information: RSIs, CCIs. This is a lot of technical analysis that some people will look into, and the chart will see people drawing stuff in the chart and saying, oh, now I see RSI is below 70. Oh, it's time to sell. Or RSI is below 30. It's time to buy. So that analysis will require you to take some classes and at least figure out whether you understand that information or not. The one thing that I can share with you, just so that you take it home today, is something called curve analysis. And curve analysis, as a trader or investor, is going to help you a lot to know when you can buy, in other words, being bullish, or when you can sell if you're going to be bearish. So if you look at a chart and you realize that there is a demand zone, there's a lot of buyers in that particular area of interest, then you want to be a buyer. If you look at a chart and draw out your lines and say, okay, I see demand, I see supply, you figure out how far is price in relation to the buyers and to the sellers. If price is near the sellers, you want to be a seller too. If price is near the buyers, you want to be a buyer too. Don't go opposite, right? So if it's in a place where a lot of people are buying, you should not be selling, because then you're going to get crushed. And if it's in a place where there's a lot of selling, you should not be buying, because it's going to drop. So the closer you are to supply zones, you want to be a seller. The closer you are to demand zones, you want to be a buyer. So this is what you need to see in a chart. And you realize there's a lot of sellers in those little guys with red suits, and the green suits. Those are the buyers. So if you look at a chart, you see the movement of price. It drops to the buyers, it gets kicked up. It gets to the sellers, it gets thrown backwards. So you should see that relationship between buyers and sellers when you look at any chart. And you don't have to be told what that stock is to be able to see this. All you need to look at, use your eyes and figure out, do I see buyers? Do I see sellers? Where is current price? Should I be a buyer or should I be a seller? So what I did was went to my stocks. There is a website there called My Stocks, and it gives some information on securities at Nairobi Securities Exchange, some stocks there. So I picked Safaricom, and I went 10 years. So 10 years. And then I downloaded that chart, and you can see in the last 10 years, price has moved from around eight shillings and kept going and rallying all the way to 45. And recently, it has had this huge drop back to around $8. So the question I have for everyone now is, if we draw out a curve analysis, remember we are analyzing how far the sellers are, how far the buyers are. So the red down here, we assume there's a lot of buyers here. These are the buyers that push this price all the way up. These are the sellers that pushed all the price all the way back to around $15. So where is Safaricom trading in relation to the curve? And you can put that on the chart box. Are you near the buyer or are you near the seller? And right in between is what we call equilibrium. So usually buyers will send price in the middle, sellers will send price in the middle, then you have a huge fight over here, and then it can either go up or go down. So you can just use that basic information to look at a chart and say, am I going to be investing in this or not? And apart from the chart, now you can talk about data. What Robert does, looks at the company and says, is it making money or not? If it's making money, it's a good company and it's trading at a discount, why shouldn't you buy it? Always think long term and think about your time frames. Am I buying this to hold for 1 year, 5 years, 20 years? How long am I going to hold it for? You need to have a different purpose. If you know that you have kids that are going to be going to school in 15 years, then you have time to wait. But if you don't have that kind of time, you cannot risk a lot of money in a stock that you're not sure about. So you need to define your purpose and your time frame. How long are you going to hold it, and why is it that you're doing it? All right, so one of my favorite authors and investors is somebody called Walter Schloss. This is actually somebody that Warren Buffett values a lot and used some of his principles to build his empire. And Walter said, tries to establish the value of the company. So remember, when you buy a stock, it's not just a piece of paper. You are a part of that business. You need to be familiar with that business because you own it, right? So here's my experience with Nairobi Securities Exchange. I'm a both a trader and investor at that market. I run different scenarios and analyses in that market. I have some long-term strategies. There are stocks that I'm going to hold for a very long time. There are some stocks that I'm going to hold for quite a bit, or there are some that I'm going to hold very short-term based on how they perform. And obviously, now they have derivatives market. This is the futures market at NSE. And the only concern I have there is that the liquidity is very low. I actually put in an order to purchase one contract for Safaricom, and it stayed there for more than 2 weeks with no entry. So that market is still in very early stages of growth. And as we get to understand that market and people obtain information on how to do it, I'm sure we are going to benefit a lot. And I wish a lot of people would get into these classes where they understand what futures markets is, because we can use leverage. We don't have to spend a lot of money to buy one contract. In this case, I would just have used 15,000 Kenya shillings to buy a contract and then wait for it to get back to around 30. At that point, sell that contract. But the concern there is low liquidity, and I'm sure it's because of education. People don't understand what that is. So CDSE has a lot of work to do, and the Capital Markets Authority has lots of work to do in educating our folks. All right, so I want you to consider this as I wrap up. Some companies are cross-listed in East Africa. So when you invest at Nairobi Securities Exchange, you need to identify your neighbors, right? They have very good businesses, and you can participate in their growth by just being in Kenya and buying those companies, like Bank of Kigali, a good company in Rwanda, does very well. You are sitting in Nairobi, buy your neighbor. As it continues to grow, that growth becomes part of you. Equity recently went all the way to DRC. You have Safaricom venturing out into Ethiopia. So you are in a unique place where you can identify good businesses, not just in Kenya, but in East Africa, and become an investor. That market, remember, Kenya has what, 55 million people? You add the population of the other 3 or 4 countries that are neighbors. Now you are tapping into a major market, and you can easily grow your wealth that way. As a matter of fact, the one dividend that I have been paid most came from Rwanda, not even Kenya, it was Rwanda, and that's Bralirwa. That company is listed there. You can venture out and think about these other companies and how they do. Don't just get closed into thinking about Kenya. All right, so patience and discipline are the parents of financial success. Patience and discipline, those are 2 things. You have to have patience, you have to have discipline. And if you lack either of those, then you're just going to have broken dreams or just products that are conceived poorly, and you end up crying because you did not invest in being a patient person and having discipline. So I'll end up with this about discipline. I don't know how many 20-year-old participating in this forum. This is a challenge for you. Well, if you're 25 or 30, you can also do it. But I'm going to give you this challenge because I wish someone had shared this information when I was 20 years old and asked me to buy shares of Barclays Bank, which is ABSA right now. 30 years later, that bank is still in existence. I wish somebody had told me to do this. So this is a challenge for the 20-year-old. We are going to identify Equity Bank, 100 shares at 37.50. It's trading around that price. So how much do you need? 3,750 shillings. That's the investment amount. We are going to hold this company for the next 30 years. So that means you want equity to continue growing. You're going to participate in shareholder meetings. You're going to pray for Mwangi Equity and all the management team to make sure that they continue growing this company, and you want it to survive for the next 30. If you believe it's going to survive for the next 30 years, then this is the challenge for you. Right now, the annual dividend yield is 10.8%. Now, how about we contribute 5,000 shillings every year? Not every month, every year. So we started with 100 shares, and every year, at some point during the year, make sure you have put in 5,000. You have bought additional shares worth 5,000. So the dividend tax rate in Kenya right now is 15%. We expect the rise in dividend payout to be about 1%. I was very conservative, just 1%. We also expect equity to grow at around 2% every year. We are going to reinvest whatever money we get from equity. It comes to us. As soon as it hits the bank, we are buying more shares of equity. We are not eating this money. I was looking at Abojani's forum the other day. Somebody said, reinvest that money before it grows legs. And it was very hilarious for me. Yeah, money does grow legs, it goes away. So we are going to reinvest that money every time it's issued. So what do you think is the ending balance after 30 years? What do you think? Go ahead and put it in the chat box. After 30 years, how much do you think it is going to grow to? All right, I don't see any responses, but I will go ahead and give you this just so that you look at it. So in 30, so I did the simulation here. I hope you can see this. Forget the dollar sign there. Just assume it Kenya shillings. So equity 37.5. We start off with 100 shares, 37.50 Kenya shillings, 30 years hold. We are going to have a 10.8 dividend yield. We are going to add 500 shillings, 15% tax rate. And now we can calculate how much it will be after 30 years, 1.6 million. So if you are 20-year-old and you want to become a millionaire by using this kind of method, 20 plus 30 at 50 years old, you will be looking at around 1.6 in your account. I'll quickly finish with this. I'll go back to the slide here. I'll finish with this. You're on mobile. I run a Discord group. We have a website there. If you want to join us and at least get these ideas or have a conversation with other investors, or even take classes and just educate yourself on how to do this. We do those classes all the time. There's actually a class available online that you can take at your own pace and educate yourself. So remember, CDSC is not going to educate you. They're not going to give you any advice. All they're going to do is say, are you ready to become an investor? Okay, here it is. Open this CDSC account, and now we can monitor what's happening to that account. But as an investor, as a financial planner, you have to take this information to heart and study on your own.